Hello and welcome to Value Research Podcast. You're listening to First Page, a column written by Dhirendra Kumar. Regulation can cut fees, not complacency. Regulatory tightening is welcome, but it doesn't replace investor vigilance. SEBI has released a consultation paper proposing a comprehensive overhaul of mutual fund regulations. Among the many changes being discussed, there's a significant reworking of how fund expenses work. This is good news, though perhaps not for the reasons you might think. The proposals include some meaningful adjustments. The regulator wants to remove a peculiar 5 basis point charge that funds could levy on schemes with exit loads. This was a transitional provision from 2012 that's lingered far longer than it should have. More significantly, SEBI proposes to exclude all government levies from the expense limits. Currently, only GST on management fees falls outside these limits, while STT, CTT, and stamp duty are included. The new framework would put all statutory charges outside the expense cap. The logic is sound. If the government changes these taxes tomorrow, the impact should flow directly to investors rather than being absorbed within existing expense limits. It's about clarity and transparency. The most dramatic change, however, concerns brokerage charges. These are being slashed from 0.12% to just 0.02% for cash market transactions and from 0.05% to 0.01% for derivatives. Note that, unlike other expense limits, this is a percentage of the transaction value, not the amount managed by the fund. SEBI noticed that arbitrage funds were paying brokerage rates of 0.01 to 0.015%, while other equity schemes were paying 0.05 to 0.12%. The higher charges were bundled in research and other services beyond trade execution. Since funds already charge management fees primarily for their research and expertise, allowing them to pay for research again through brokerage amounts to charging investors twice for the same thing. All of this sounds rather technical, and it is. But here's what matters. These changes are about bringing down costs and making them more transparent. Lower costs mean better returns for investors, and transparency lets you see what you're paying for. Both are unquestionably good things. However, and this is the important bit, regulatory action doesn't absolve you of responsibility. The regulator's job is to set the boundaries and ensure fair play. Your job as an investor is to pay attention to what's happening within those boundaries. Just because expense ratios are now better regulated doesn't mean you can ignore them. Expenses are one of the few aspects of investing that you can actually control. You cannot control market returns. You cannot control how well a fund manager will perform next year. You cannot predict which sectors will do well or when the next correction will arrive. But you can absolutely control how much you pay in expenses by choosing where you invest. It's the single most predictable drag on your returns. Consider this. If two funds deliver identical gross returns over 20 years, but one charges 0.5% more in annual expenses than the other, you'll end up with substantially less money in the higher cost fund. Over 2 decades, that difference compounds into a rather painful gap. It's mathematics, not opinion. Yet, most investors barely glance at expense ratios when choosing funds. Past returns tell you nothing about future returns. Fund manager reputations can be misleading. Market conditions are beyond your control. But expenses? Those are knowable, predictable, and directly relevant to your actual returns. The constant regulatory examination of expense structures is welcome precisely because so many investors don't pay attention to costs, but relying entirely on regulatory protection is a mistake. The regulations set maximum limits and ensure basic fairness. They don't make your investment decisions for you. When selecting a mutual fund, consider the expense ratio. Compare it with similar funds. Understand what you're paying for. If you're investing through a regular plan with a distributor, recognize that you're paying for that advice through higher expenses. If you're going direct, make sure you're actually getting the lower costs you're entitled to. These aren't complicated checks, but they require you to actually look. Regulatory tightening helps everyone, but it helps most those who are already paying attention.